Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in.
Welcome to episode 67 of Blue Chip Now. You got Matt and Dan here today. Daniel's out on taking a much needed vacation. And we thought today we'll do something a little different. So obviously markets have been very volatile, to put that mildly, since the beginning of March or so. And, there's a lot in the news. There's a lot of things being put out there by the financial media. Dan and I have been on the front lines of receiving some client questions here and there. And we thought, what better way to deliver some answers, give some insights than this podcast here today? So Dan, with that said, we have the S&P 500 down off its all-time high around 8.5%, give or take. What's going on? From a client's perspective, what should they be feeling? What action will we be looking to take? There's a lot to talk about. So
yeah, let's take a half step back before we jump into the markets and talk about what's causing some of this volatility. So what's really the root cause? And I think the root cause is the idea that tariffs could potentially spike some type of recessionary fears or lead us into a recession. And so Daniel put a note out internally about a week ago regarding the tariffs. And I think at the end of the day, the message that I want to get across is it's really impossible to say. We always say that about stocks in general in the market. We don't know the extent of the tariffs. We don't know how long the tariffs are going to last. But what I feel very confident in is that this too will pass. And so it's the topic du jour right now. And we've had hundreds of these over the last decade or more, where when you're in the moment, you always think this is the thing that's going to send the market down to zero.
Yeah. And it's interesting too, because we had a situation leading up to this, again, taking a half step back. The situation leading up to this was a market that was priced for perfection. We had the Magnificent Seven, the AI, if you want to call it rush, CapEx spending spree on AI. These all occurred at a point when the transition between Biden and Trump took place, that the transition to a more, let's say, tariff-focused regime took place. And also, kind of with the Doge operating in the background, cutting some government workers. This all occurred at from the market's perspective, a time when it was priced for perfection.
And there's changes. Changes are being instituted. Whether you agree with them or disagree with them, there are changes, and those changes are going to cause a disruption. And I think the deal that is ultimately struck across the globe when it comes to trade will be resolved. And I do think that over time, the U.S. ends up with the upper hand. And so I'm not looking at this thinking that this is the reason that markets are going to crash and that investors right now should be running for the fences. I don't want to go into sentiment. We talked about sentiment recently, but sentiment is totally washed out. And so from an investor's perspective, we talked about this morning. It might not be the best time to buy, but it's certainly not a time to sell. When sentiment is this bad, you want to look at the markets and use sentiment as a contrarian indicator.
Yeah, historically speaking, over the next 12 months, its sentiment levels where they're at today, the markets would be positive. Now, of course, it can always be different this time, but from a historical basis, that's worked all the time. Yeah. So very strong indicator at extremes. We're at an extreme.
Last comment before we jump into some of the market data. The tariffs, the debate on are they recessionary or are they inflationary? How inflationary are they? Are we going to go into a recession? A lot of unknowns. The one thing that could happen that I think would be an unintended consequence of all of this is a market-induced recession where you have stocks selling off and then there's fear, and then all of a sudden it's this momentum where everybody starts running for the fences at the same time. Almost like some of the banks and the banking crisis that we experienced, when you lose the full faith and credit of the institution that's holding your funds, that bad things can happen. And so it's it could end up becoming a bit of a crisis of faith. and what people anticipate will occur. And that could be a self-fulfilling prophecy.
Yeah, and that's interesting, and I just came across this over the weekend, but the top 10% wealthy people in this country own 87% of the stocks. And we've talked about this for many years. This isn't a new phenomenon by any means, but the top 10% doing markedly better than the bottom 90%. So that will be interesting to see if the top 10% who have been carrying the economy start to feel a little more reserved in their spending due to the markets pulling back. So that could be certainly something. I don't know if it would be enough to drive a recession, but it could certainly bring spending down to a more anemic level than what we've seen in the past few years.
Yeah. Well, I would say outside of those root causes, which leads us now to talk about the markets, what we're seeing in the markets is risk-off behavior. So you're starting to really see signs that investors are taking their foot off the gas. They're actually putting their foot on the brake. And now let's dive into some of the data or the indicators or the analytics behind what the markets are doing. Maybe I'll start. One of the market indicators that we look at is the VIX, the volatility index, and the VIX is also called the fear index. And so when this index spikes higher, markets are generally dropping lower. And so we've seen that occur. A big jump in VIX and a big drop in stocks. The S&P 500 recently dropped below its 200-day moving average. So if you look at the last 200 days of market action and you average that in a line, so it smooths out the last 200 days, the stock market dropped below that line in the sand. And a moving average can often be thought of as a risk management tool. So own stocks when you're above a 200-day moving average, don't own stocks when you're below. So we just dip below.
And I would just a caveat, that's much more of like a trading strategy. So it's not something we would necessarily implement, but yeah, that is when you're below the 200-day moving average, there's some cause for caution.
Yeah, well, and in fact, it's a risk management strategy. But when you back test the long-term results of what if I get out every time I'm below a 200-day moving average, you actually markedly underperform the market. So that's not a winning strategy for a positive outcome. That's just a risk management tool for people that can't afford to take risk or can't stomach taking risk.
Gotcha. Okay. Yeah. Thanks for clarifying. And, I say also, this is more of a technical conversation, but the market is oversold. When we say the market, the S&P 500 is, technically speaking, oversold, right? We look at various indicators on the market. One that we quote frequently is RSI, Relative Strength Index. Again, the best way for someone to think of that is, price is when you look at the S&P 500 chart graphically, that's the speed you're going on the freeway. This would be the second derivative. This would be how fast you're accelerating or decelerating. In this case, we're decelerating pretty hard, so that's one area where, again, not a perfect timing tool, but would lend to say that you wouldn't be surprising to see some of like counter trend rally.
And that brings me to, I saw a really interesting stat by Ryan Dietrich. He's a market technician and reemphasized, and there's a lot of ways to cut this data, but, and I don't like general stats like this, but this one really stood out to me. The market since 1990 has averaged just shy of 10% per year, the S&P 500. And if you took out the 10 best trading days per year, just the 10 best trading days in arguably like 252 day trading period, the market was negative almost 13% per year.
It's amazing.
And so what that means is the really big days in the stock market are really important to be a participant in. Now, when do those big days occur? Those big days don't occur when markets are at all-time highs. The market isn't at an all-time high and then you see some 8% jump higher in stocks, collectively speaking. Where you see a big jump in stocks is after a pullback and the ensuing rebound from those positions. So this is part of the game. What investors have to realize is that this is normal. Even though it's uncomfortable, you have to lower your shoulder, grit your teeth, and get through it, because it's a normal part of being an investor.
Yeah, and two things kind of come to mind with that. Number one, we talked about the VIX and volatility being high. Well, it's not just downside volatility. That includes upside volatility. So when the VIX is high, to your point, you have the circumstances are right for larger up days as well. So that's I think that's like a major point that we can't take for granted either. The markets are going to do their thing. I think also for people, for individual investors who are feeling right now like, oh man, the markets have been down, they've been down. This is normal. But also, when in doubt, zoom out a bit. And over the 1 year, over the 3 year, generally speaking, you should be very positive from the market performance, since 22.
We're not that far off all-time highs, not just revisiting a prior high, all-time highs in stocks. And so these are great periods of time to remind investors that stocks don't just move in one direction, straight up. They go up and every now and then they go down. The history of the stock market would suggest that every 7 years you have 6 advances for every decline. And so it's the dance of the stock market. 6 steps forward, 1 step back. 6 steps forward, 1 step back. So that is totally normal. Now, I want to clarify because we, just like the media, just like our clients, like most investors, generalize the stock market as the market, and we're typically talking about a composite index like the S&P 500, which is market cap weighted. It favors or it gives the largest companies more influence on performance. So if Apple is a huge company and does really well, it'll pull the index up. If Apple is a huge company and it's doing really poorly, it'll pull the index down. Well, when we look at the stock market on an equal weighted basis, meaning the same 500 companies in the S&P 500 composite, but give each company an equal shake. So an Apple might have the same influence as a Johnson Controls. When you look at at the stock market on an equal weighted basis, things aren't that bad. Really, where you're seeing a big part of this sell-off is in the Mag 7. It's in the companies that over the last couple of years have been virtually untouchable.
Yeah, and that leads to concentration risk. But when everybody is buying the same stocks, you run out of buyers, and then you can have some downside. Some downside with that too. There's companies like Abbott that are up almost 20% year to date. There are companies that are up. I know CVS is a big gainer. There's a bunch of companies I could go through that are actually wildly positive, but they're the more value-oriented stocks. They're less the ones that have done really, really well over the past 3 years.
Yeah, and then a great way of looking at that is if you took a composite of all the discretionary companies, consumer discretionary, I mean the consumer has the choice of whether they want to buy this item or not. It's not a staple. It's not something that they absolutely need. That's a requirement. And when you look at that relationship of the discretionary companies relative to the staples are outperforming dramatically. And that's something that is typically a risk-off move, which makes sense. But we're seeing it in the market data. The question is how long does this last? And have these bumps and bruises to the stock market, are they going to cause serious concern? And I still hang my hat on. The answer is no. I think we're 1 or 2 headlines away from being back to all-time highs based on change in rhetoric from the Oval Office. So this environment can change so quickly. It can change so quickly. The idea that the world's going to end, and this is the reason the history books are going to write about the downfall of the U.S. because the tariffs were put in place. Just it's not going to happen that way.
Yeah, and I think what this does go back to, one thing that won't go out of style is diversification. And I think I bring this back to that concept because, we're in a really strong stretch going back to literally the market bottom of 2009, where the S&P has really been the main game in town. That market cap weighted index that's been biased towards technology has done phenomenally well over the past 15 years. These are these types of periods where it kind of makes you start to rethink that approach, that market cap weighting approach. and you really focus on business fundamentals of good companies, like you said, that are out there, where consumer staples might be underrepresented in an index, but is doing really, really well.
Yeah,
so far.
And it sounds boring in a world of fast money. Jim Cramer's fast money. Everybody thinks that the stock market is a bunch of day traders, and certainly there are some day traders. But really, when you break it down to our level, when we're dealing with successful families and investors that are interested in putting together a plan for retirement and successfully executing retirement, it really comes down to the basic blocking and tackling. It's really not that crazy and sexy and exciting. Asset allocation and diversification are step one. Building that into a financial plan is step two, or arguably the reverse. Maybe the financial plan's first, but the point is that you have a plan and you invest according to the plan. You don't always have to achieve a 25% rate of return in order to achieve your goals. Would everybody like to make 25% per year to watch their balance sheet go higher? Sure. But a lot of times it comes down to mitigating the ups and the downs through techniques like asset allocation and diversification.
Yeah, and I think that goes to what we do behind the scenes, right? We're not just picking stocks to pick stocks. We're not just picking allocations to pick allocations. All of these things are thought of for moments like this, right? Where we want to be a little different than the market. We understand the flaws in the market, and it really comes down. This is the point of that. Like, markets like this are the reason we don't just follow the S&P.
So Matt, maybe this is the drop the mic comment that I'll make, and then we can call it a wrap on today's episode. But when we talk about our clients and the conversations we've had with our clients and the way that we manage our portfolio, it's predicated on a couple of things: high quality companies that pay and grow a dividend. And so in an environment like this, our clients who, yes, they're experiencing volatility, aren't experiencing changes to the level of income that they're receiving from the portfolio. They might be working, so they're reinvesting that income and buying more shares at a lower price. They might be retired and collecting that income just by taking distributions from the portfolio. But the idea of the markets, keep in mind, when you have a plan an investment plan that backs into a financial plan, and part of that focus is on income and income growth, the income that our clients are generating from their portfolios in this environment has not changed. It has stayed the same. And so I think that's one important point that I want to get across and remind our investors and those that are listening. So maybe with that, we'll call it a wrap. Thank you so much for tuning in to another episode of Blue Chip Now, and we look forward to chatting with you again soon.